In the late 1990s, during the peak of the dot-com bubble, millions of Americans were getting rich on paper almost overnight. Tech stocks doubled in weeks. Taxi drivers were giving stock tips. College students were day trading between classes. And then there was Warren Buffett. While the world was chasing internet IPOs, Buffett was sitting on billions in cash, refusing to invest in companies he didn't understand. People called him outdated, too conservative, even finished. Within 2 years, the bubble burst. Trillions in market value disappeared. And Buffett? He was still standing. That moment reveals something uncomfortable. The world rewards excitement. Wealth rewards discipline. You know Warren Buffett as one of the richest investors in history. But the real question isn't how he made billions, it's how he kept them. And more importantly, how he structured his life so money worked for him instead of controlling him. Because here's the psychological truth most people ignore. Making money is a skill. Keeping money is behavior. And behavior is harder. Today, we're breaking down Buffett's saving philosophy, not as generic advice, but as a financial operating system. One that looks simple on the surface, but quietly compounds into extraordinary wealth over decades. Let's start with the first uncomfortable truth. When income rises, spending rises with it. Economists call it lifestyle inflation. Psychologists call it hedonic adaptation. You call it, I deserve this. You get a raise. You upgrade the apartment. You upgrade the car. You upgrade your vacations. And suddenly, your financial life looks the same as before, just with bigger numbers. Buffett understood this early. Despite being worth billions, he still lives in the same house he bought in 1958 for $31,500. Not because he can't afford more, because he doesn't need more. That distinction changes everything. Most people tie their identity to visible consumption. Buffett separates identity from spending. His lifestyle is stable. His assets grow quietly in the background. If tomorrow $10 million landed in your bank account, what would change first? Your investments or your lifestyle? For most people, lifestyle wins. And that's why wealth disappears faster than it's built. Buffett's first principle is deceptively simple. Design your life so your expenses don't automatically expand with your income. Because income is temporary, markets fluctuate, careers shift, businesses fail. But a high-maintenance lifestyle, that becomes permanent. And permanence is expensive. Now let's move to the second principle. Avoid compulsive buying. Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. Most people think he was only talking about stocks. He wasn't. Impatience drives almost every financial mistake. A new phone launches. You want it. Your current one works fine, but desire feels urgent. That urgency is psychological, not financial. Companies spend billions engineering that feeling. Scarcity marketing, limited drops, countdown timers, social proof. Buffett does the opposite. He waits. When he buys a company, he waits for the right price, sometimes for years. He doesn't buy because something is exciting, he buys because the math makes sense. Imagine applying that to your own spending. What if every purchase over $1,000 required a 30-day waiting period? How many decisions would disappear? Patience isn't passive, it's strategic delay. And strategic delay saves enormous amounts of dollars over time. Now the third principle. Price is what you pay, value is what you get. This sounds simple. It's not. Most people optimize for low price. Buffett optimizes for long-term value. Let's say you buy a $50 pair of shoes every year. Over 10 years, that's $500. Or you buy a $250 pair that lasts a decade. The cheap option feels smart. The durable option is smart. Buffett buys businesses the way most people should buy assets, as if he intends to hold them forever. That changes the decision framework entirely. Instead of asking, how cheap is this? He asks, how durable is this? Applied personally, this transforms spending. Are you buying things that create temporary excitement or assets that produce long-term utility? Because every dollar has two possible futures, consumption or production. Consumption ends the story. Production continues it. Now the fourth principle, and this one is foundational. Save first. Spend what remains. Buffett once said, "Do not save what is left after spending, but spend what is left after saving." Most households operate backwards. Income comes in, bills get paid, lifestyle gets funded. Whatever remains, if anything, goes to savings. But human psychology ensures there's rarely anything left. Buffett started saving as a child. He bought his first stock at 11, filed his first tax return as a teenager. Not because he was wealthy, but because he understood something about time. Compounding needs two ingredients: money and time. Miss either one, and the engine weakens. If you invest $500 per month starting at age 25, earning an average 8% annual return, by 65, you're looking at over $1.5 million. Start at 35 instead? That number drops dramatically. The math isn't emotional, it's mechanical. But most people delay because saving feels restrictive. Buffett reframes it. Saving isn't restriction, it's future freedom. When you save consistently, you buy options. The option to leave a job, the option to invest in opportunity, the option to handle emergencies without panic. Liquidity is psychological power. Now the fifth principle. Think like an investor, not a consumer. Buffett has experienced massive drawdowns. In the 1973-74 crash, markets fell nearly 50%. In 2008, financial institutions collapsed. His portfolio suffered. But he didn't panic because he understood the system. Markets move in cycles. Fear is temporary. Value endures. An investor mindset views dollars differently. When most people receive $5,000, they think, "What can I buy?" An investor asks, "How can this produce more?" That subtle shift compounds over decades. Instead of spending $5,000 on a depreciating asset, you invest it in productive assets, stocks, businesses, index funds, cash-flowing investments. Over time, those assets generate income streams, and income streams create independence. Here's the larger societal tension. Modern economies are built on consumption. Advertising encourages dissatisfaction. Social media amplifies comparison. Easy credit removes friction. You can finance almost anything instantly, but ease has consequences. When you use future income to fund present desires, you trade long-term flexibility for short-term status. Buffett doesn't play that game. He ignores trends. He avoids unnecessary leverage. He stays within his circle of competence. And perhaps most importantly, he controls his emotions. Because at its core, personal finance isn't mathematical, it's behavioral. You already know most of these principles. Live below your means. Avoid impulsive purchases. Prioritize value. Save consistently. Invest for the long term. The reason they're rarely followed isn't ignorance, it's discomfort. Discipline feels slow, boring, invisible. But wealth built on excitement is fragile. Wealth built on restraint is resilient. Now let's return to the beginning. During the dot-com bubble, Buffett looked outdated. During market crashes, he looks patient. Over decades, he looks inevitable. That's the difference time makes. If your income doubled tomorrow, would your lifestyle double with it? Or would your assets? Because becoming wealthy is impressive. Remaining wealthy is structural. Warren Buffett's saving advice isn't flashy. It doesn't promise overnight success. It doesn't sell urgency. It sells control. Control over spending, control over emotion, control over time. And maybe that's the real secret. Not how much money you make, but whether your behavior allows that money to stay, grow, and work long after the excitement fades. So the real question isn't whether you understand Buffett's strategy. The question is whether you're willing to live it, quietly, consistently, and without applause. Because in the end, wealth doesn't shout, it compounds.